各位都非常熟悉的著名经济学家，野村综合研究所首席经济学家辜朝明先生。辜先生的研究和观点一直都是能在学界和业界激起很大的回响，而他为了今天的论坛也是进行了精心的准备。我想请大家看一下自己的座位上会有一份资料，大家看到了吗？有一份不薄的资料啊，这一份资料呢是辜先生为今天论坛精心准备的他的演讲的大纲，里面会有丰富的数据材料和图表。那稍后呢，大家可以对照着这一份资料，一起来聆听辜先生这个重磅的40分钟的闭幕演讲。好，那么下面我们不多说，请导播马上把信号接入此时此刻的台北现场。Hi, good afternoon, Richard.
Good afternoon.
Hi, can you give us a big heads up? What's your topic today?
Well, I'm going to talk about monetary policy in the United States and how China looks compared to perhaps Japan 30 years ago.
Okay,
so
great.
Those two topics.
Great. I guess we can wait. I'm going to hand it over to you. Thank you.
Okay. Good afternoon to you all. I'm very much honored to be invited to this very important forum covering so many issues that are affecting this area. I was asked to talk about Federal Reserve monetary policy together with where China may be going. Well, as all of you are aware, Federal Reserve is fighting inflation. China, on the other hand, is fighting deflation. So two are going in a completely different direction. So I have to be very careful how I split my time because I want to give equal treatment to both of them. For the Federal Reserve, we have to realize that this is the first time in history where central bank is tightening monetary policy with huge amounts of excess reserves already in the system. This has never happened before. In the past, the amount of excess reserves in the banking system was always limited, and central banks in those days usually had two policies, two levers, as it were. One is to raise interest rates or lower interest rates. The other is to tighten the availability of reserves. Now, those two measures are not always independent. One, of course, affects the other, but central banks always had two. And 1979, when Paul Volcker, who apparently is Jay Powell's hero, when he squeezed inflation out of the U.S. system, what did he do? He basically squeezed the availability of reserves. And the banks don't have that much reserves. They scramble for the remaining reserves. As a result, short-term interest rates went to 22%, squeezing the market. And with 22% interest rates, the economy slowed down and inflation slowed down. That's the direction it went. This time, however, I'm afraid Mr. Powell does not have that option because the excess reserves in the banking system is so huge that to reduce that to a point where banks really feel the pain will be very, very difficult, and it's going to take a very long time. So just to see this chart shows three monetary aggregates. Monetary base, that's the red line. That's the amount of reserves. That's the amount of liquidity the central bank provided to the market. And then the blue line is money supply. That's how much money we have in our bank account. That's the money we can use. And the green line is the amount of credit that was extended by American banks to the private sector. And if you remember your economics, we were told that these lines are supposed to move together. That is to say, when the central bank increases monetary base by 10%, money supply credit increasing by 10%. Remember that in your college days? Well, that world did exist until 2008, a Lehman crisis right here. So three lines were moving beautifully together. Then when the Lehman Brothers crashed, collapsed, and then the market crashed, we fell into the global financial crisis. Federal Reserve increased monetary base by quantitative easing 1, quantitative easing 2, quantitative easing 3, all the way almost 400% increase in the amount of reserves in the banking system. But look what happened to the other two. They completely decoupled. Money supply grew very slowly, but the credit actually shrunk. Why did it shrink? Because when the bubble burst, asset prices collapsed, but all the liabilities remain at the original values. People had their balance sheets underwater. Many of them were technically bankrupt because asset prices are down so much, liabilities are still up there. So they all had to reduce their debt. And that's the right thing to do at the micro level. But when everybody does this all at the same time, we fall into what we call balance sheet recession. And balance sheet recession happens when people all try to repair their balance sheets at the same time. Individually, they're doing the right things. But when they do it together, economy collapses, because in a national economy, if someone is saving money, someone has to be borrowing and spending money. And in the usual economy, it's people like us, you and I in the financial sector, taking the money from the savers, giving to someone who can use it. If there are too many borrowers, central bank raises interest rates. Too few borrowers, central bank brings rates down. That's how the economy is usually maintained. But once a major bubble bursts, asset prices collapse, liabilities remain, everyone start paying down debt all at the same time. This is what happened here. The green line actually shrinking. And it took about 3 years for Americans to basically pay down debt. And then it grew very, very slowly thereafter. So during this entire period, monetary policy was very, very ineffective. And as you are all aware, all that time, they were trying to meet this 2% inflation target, but they kept on missing it. As you can see at the bottom, this is what happened to the inflation rate in the United States, and they kept on missing it. So they kept on increasing the monetary base, trying to meet that target. And when the pandemic hit, they of course increased the monetary base even more. So we are starting from this level. We have to bring this down to, somewhere close to this level so that we can remove this excess reserves in the banking system. But the gap between the two is so large that they cannot use the excess squeezing of the reserves to tighten monetary policy. They have to use interest rates to tighten monetary policy. And I'm afraid they have not been very successful up to now. This chart shows Chicago Fed's National Financial Condition Index. That's the blue line. This shows how tight or how difficult it is to borrow money. And the red line is the Federal Reserve interest rates. And back in the 70s and 80s, every time central bank brought interest rates higher, Financial Condition Index also went higher. That means it became difficult to borrow money. But more recently, you notice that there was one tightening here, another tightening here, but the Financial Condition Index is not responding. Even though this time the tightening was very sharp, as all of you are aware, Financial Condition Index is still negative 0.42. Negative means it's still easier than it was. It was still easier than the average of the last 50 years. And if it's negative, they are not going to be able to tighten, have much impact on the economy. So that's why they kept on tightening. And this is what is so difficult about the Federal Reserve policy today. But this is not just the Federal Reserve issue. Bank of England, European Central Bank, and eventually Bank of Japan will face the same issue of how do you tighten monetary policy when there's so much excess reserves already in the banking system. And the reason why this is not working so well is because, as I said, there's too much excess reserves in the banking system. Banks have so much money to lend. These are quotes that I collected from so-called Beige Book. That Beige Book is something that Federal Reserve put together from their 12 district Federal Reserve banks. So there's San Francisco Federal Reserve, Dallas Federal Reserve, St. Louis Federal Reserve, Philadelphia Federal Reserve. They all write into this package. And when you read some of those things that says what's happening in the banking system, they tell you that competition for loans remained brisk. Brisk means everybody's competing for the few borrowers. You notice that there are not too many borrowers in the United States, but the banks have so much money, so they are competing for the borrowers. And liquidity was elevated. This is the $3 trillion that I mentioned to you earlier. And if you just go back a little bit, for example, April 2022, some banks have eased credit standards to compete for loan customers. Because Americans are not borrowing money, but the banks are stuck with this huge amount of reserves. They want to lend, so the competition among banks have been very fierce. So they had to lower the lending standards. And so Federal Reserve was tightening, banks were loosening, and as a result, financial conditions remain relatively loose. That's why the Fed has to keep on tightening or raising interest rates, because that's the only tool Federal Reserve have during this tightening cycle. Whereas in the past, they could use both squeeze the reserves as well as raise interest rates. This time they only have interest rates tools. And my guess is that they will probably have to raise rates perhaps one more time, maybe additional times, if they feel that those rates are not enough to overcome this excess reserves in the banking system and still tighten monetary policy. We have never experienced anything like this before, so we have no guide as to at what level interest rates will start having impact. In the past, if you raise interest rates 300 basis points, it should have had quite a bit of impact. But this time around, because of these things that's happening, I'm afraid they might have to raise more than 500, perhaps even more than 600 basis points before it will really have an impact in bringing inflation rates down. And of course, at the same time, Federal Reserve is bringing this excess reserves down. And so right now, the excess reserves is up here. And they're bringing down like this, as you can see. This is the holdings of U.S. Treasuries and the mortgage-backed securities. Those were the instruments the Federal Reserve used to put money into the system. So now they're trying to reduce their holdings to take the money away from the system. But even though they're doing it, as you can see, it's a long way to go. It's going to take maybe 5-6 years before this number is down to somewhere more reasonable. And so we're going to be in this very uncertain world, the world that we never experienced before for quite some time. I'm sure at some point inflation rates will come down and come down to a level that will allow Federal Reserve not to tighten interest rates, anymore. But it is a very uncertain game at the moment because we have no past experiences to go by. This is the first time, as I said earlier, that Federal Reserve or any central bank is trying to tighten monetary policy with so much excess reserves in the banking system. And in terms of how much deleveraging by the Fed relative to, for example, government budget deficit, this chart shows this amount here is the budget deficit of the U.S. government last year, 2022. And the Federal Reserve is trying to remove this much, $1.14 trillion of excess reserves this year. And it's going to take, this many years before they can actually bring the excess reserves to more or less normal levels. So it's going to be a long journey. And this is what they said they are going to do, 1.14 trillion. That's almost the size of the U.S. budget deficit. So the situation in the U.S. bond market is like doubling of the U.S. budget deficit. So far, the market hasn't paid that much attention to it because they're always thinking that, pretty soon inflation rates will come down. We don't have to worry about the bond market. But most recently, that is to say the last 2 weeks, that is, even though Federal Reserve kept the short-term rates unchanged from the last FOMC, you notice that long rates have been actually moving up higher. And that may be something that we should watch very closely, because if Federal Reserve kept the federal funds rates constant, but long rates kept on creeping up higher, that means the market may be losing confidence in the Federal Reserve ability to bring short-term inflation rates down. And if this trend continues, some market, it could be stock market, it could be bond market, it could be real estate market, could crack at some point, as it happened in the Black Monday, October 1987. October 1987, the Fed was tightening to contain inflation, and suddenly the stock market gave up, and then we ended up in this situation called Black Monday. I'm sure we are pretty far away from that situation, but the fact that the last 2 weeks we are seeing long-term rates rising, even though Federal Reserve kept the rates unchanged, does give me a little room for concern, because the other way around, if the Fed is tightening but the market is not moving, that shows that the market has a confidence with the Federal Reserve. But if the Fed is not moving but the market is going in the opposite direction, then that means they're beginning to perhaps lose some confidence that the Fed can contain inflation relatively quickly. And those situations are not very positive for the stability of the market. And so I hope we don't get into anything like Black Monday going forward. But I think Federal Reserve has become very careful. You probably noticed, moving interest rates in very small portions, just to make sure that we don't push this thing too far. Because if we push too far and if market cracks, then we'll end up in balance sheet recession all over again. And so instead of soft landing, we may end up in square one with the balance sheet recession, and that will be very, very unfortunate. So I'm sure Federal Reserve is aware of all the risks that I mentioned here, and are going very slowly at the moment, because we are at that level where if it works, great, then inflation rates will be down. But if it doesn't work and the Fed has to keep on moving it higher, then we do run into the risk that some market may crack at some point. And so we are in a very delicate situation. I hope we will manage to go through it, but that will require quite a bit of skill and quite a bit of attention to what's happening to the market expectation of where inflation rate may be and what the Fed might be doing going forward. So that's my view on where the United States is. And this is common to all the central banks that did QE. So Bank of Japan, European Central Bank, Bank of England, they will be all going through the same kind of thinking and same kind of analysis to make sure that they don't break their markets. And all of that came because of all these excess reserves that were pumped into the system after 2008, as you saw in on my first chart. So that's for the United States. Let me then shift to China. A lot of people have asked me over the last couple of months, is China going through the way of Japan? And I was in Japan the whole period and observing the big bubble developing and the collapse of it. So I can tell you a few things about what happened over there. This chart shows what happened to Japan's commercial real estate. And a Japanese bubble was led by commercial real estate, not by housing. And it went up like 5 times in 5 years. This is 20, this is 100, and it's just 5 years between the two. So you know how humongous the bubble in Japan was. And the Japanese GDP at the time, in both in nominal and real terms, went up very sharply because people felt rich, decided to spend a lot of money. But then the bubble burst in 1990, and then you can see that it came down very, very sharply, came down to the level of 1987, down, 1973, down 87%. Now try to imagine in China, where prices are down 87%, not just in the little corner of Beijing, but also in Shenzhen, Shanghai, Chengdu, everything down 87. What kind of economy you think you got left in China? and you look at what happened to Japan's GDP, it never fell below the peak of the bubble. It was always above the peak of the bubble. This line is the peak of the bubble. So it's always above the peak of the bubble. That's, in my view, the Japan's miracle. After losing wealth 87% nationwide, how did Japan manage to keep its GDP from falling? Because there's another example of this, and that's the Great Depression in the United States back in 1929. Same thing happened. Market crashed. Everyone stopped paying down debt all at the same time to repair their balance sheets. So this was a balance sheet recession. And look what happened to US GDP. It fell 46% in just 4 years. Japan lost more wealth as a percentage of GDP than the Americans from 1929 to 1933. But the Japanese GDP was never below the peak throughout this period. Well, how did they do it? Very simply, the government borrowed the money and spent it. So as I explained to you earlier, in a balance sheet recession, everybody's paying down debt. No one is borrowing money. But if government came in and borrowed the money and spent it, then there's no reason for GDP to fall. And that's basically how Japan managed to keep its GDP from falling. What that means is that when you are in this type of recession, what I call balance sheet recession, one should not rely on monetary policy, which is what United States and others did after 2008, which is why we are stuck with the kind of problem that I just explained to you a few minutes ago. There's excess reserves in the banking system that you have to deal with. Instead of relying on monetary policy, they should have just relied on fiscal policy. And if government borrowed the money, put back into the system, then there's no reason for GDP to fall. And then people have the income, because the GDP is maintained, people have the same income as before. They can use the income to pay down debt. And it took Japan quite a long time to repair the balance sheets. So this is what happened to Japan, so that you can compare this with China later on. This chart shows who borrowed money and who saved money in Japan. There's a horizontal line going across zero. Above zero are the people saving money. So household sector, the red line, is above zero. And you expect household sector to be saving money. And then the green line is the government line. The blue line is the corporate line. And this thin purple line is the rest of the world. And the way this chart is put together is that if you put all these lines together, you get zero. So what that shows is that in each of these years, who saved the money and who borrowed the money. And when you look at this, you notice that during the bubble days, household sector was saving money. Government was in financial surplus, so they were running budget surplus. Current account was in negative range, means Japan was running huge trade surplus, and corporate sector was borrowing massively, almost like 12% of GDP. Then once the bubble burst, you see this line, corporate sector reducing their borrowings. By 1999, it's above zero. By 2002, it's even bigger than the savings in the corporate sector is bigger than the household sector. But we all learn in our universities that household sector is supposed to save, corporate sector is supposed to borrow. But in the Japanese case, as you can see, both corporate sector and household sectors were above zero. They're both saving money. And that's how we got into deflation. But luckily, government borrowed the money, doing the opposite of the corporate sector. And that's how Japan managed to keep its GDP from collapsing. So the key lessons from Japan is that when you are in this type of recession, what I call balance sheet recession, government has to borrow and spend the money to keep the GDP from falling. As long as GDP is maintained, people have income to repair their balance sheets, and soon enough, they will come out of this balance sheets. In the Japanese case, however, it took a very long time, almost 20 years, to repair their balance sheets. This chart shows what happened to financial assets and financial liabilities of corporate sector in Japan. As I said, Japan was led by commercial real estate, so it was the corporate sector that led the bubble. So this is how much Japanese corporate sector increased financial assets. This is how much the Japanese corporate sector increased financial liabilities, the borrowings. And the net number is this number. So during the bubble days or before, Japanese companies were borrowing money, just like you expect during in a textbook economy. But once the bubble burst, you see this orange line shrinking. And by 1997, orange bar is above zero. Above zero means they're actually paying down debt. And by then, Japan's interest rates are already down to zero. And they keep on paying down debt, orange bars above zero, for another 15 years or so. This is the balance sheet recession that I'm talking about. And more recently, the last 10 years, orange bars are below zero. So I can assure you that Japanese balance sheet problem is already behind us. Japan now has one of the cleanest balance sheets in the world. But the net number is still above zero. Why is that net number still above zero when balance sheet's already repaired? Well, once companies or even individuals go through this process of paying down debt, and I can assure you, paying down debt is a very, very painful process. After that, they say to themselves, I'll never borrow money again. It's such a painful process. Americans who lived through the Great Depression, and you saw the picture earlier, they never borrow money until they died because the experience was so bad. So Japan, we have the same problem. So even though balance sheets are repaired, on a net basis, they're not borrowing money, unfortunately. But once this number comes below zero, then we can really say Japan is out. Japan is now maximizing profits in a normal textbook way. So some of you are thinking of investing in Japan, please watch this number very carefully, because once this number is below zero, then we can really say, aha, Japan is out of this so-called Japanization. Japan is now going to, maximize profits in the way they're supposed to. Now, compared to Japan and China, this is what happened to Beijing house prices compared to the Japanese house prices during the same bubble period. And you can see that the magnitude is almost the same. And we are now hearing that a lot of Chinese people are paying down debt, not borrowing money. What that suggests to me is that even though statistics shows that the house prices are still up there, maybe the actual market prices are below that, or people do not believe that these house prices will continue to go up. Balance sheet recession happens when people realize that they were chasing wrong asset prices. So in the Japanese case, when house prices start falling, many of them at the beginning said, aha, this is a temporary correction, nothing to worry about. So they stayed put. As long as they don't change their behavior, you don't get into balance sheet recession. But after a year or two, they realized that, oh no, we were chasing wrong prices. So then they start paying down debt. Then that's when you go into balance sheet recession. In the Chinese case, the fact that so many Chinese people are already not borrowing money or actually paying down debt, that's what I hear from the Chinese bankers, suggests to me that they are already believing that house prices will probably not go that much higher from here, or maybe actually already falling. And once that perception becomes dominant, then people will be paying down debt, and then you fall into balance sheet recession. Now, one big difference between the Japanese and Chinese situation is that looks like a lot of people in China already are aware of balance sheet recession. This is an article that came out on some Chinese newspaper more than a year ago. And the big problem in Japan back 30 years ago is that no one knew anything about balance sheet recession. It's never taught in universities. And until I came out with this concept around 1996, 1997, no one in the world knew anything about how this balance sheet recession works. And so we were all puzzled in Japan. I was in Japan at that time. We brought rates down to zero. We tried some fiscal policy. We tried some structural policy. Nothing seemed to work. Fiscal policy was actually working because every time the government spends the money, economy responded. But then when they removed the fiscal stimulus, economy tanked again. Why did it tank and not start this pump priming that you expect from Keynesian fiscal stimulus? Well, because everybody was repairing balance sheets. And repairing balance sheet takes a long time. 5 years, 10 years, even under the best of circumstances. And in the Japanese case, as you saw earlier, it took 20 years. So you have to maintain fiscal stimulus for that long to really effective. But the Japanese did it in a kind of a stop and go way. You put it in, it looks like it's responding, they removed it, economy tanked again, and then put it back on. And so it was a zigzag. If they did it more systematically in sustained manner, I'm sure Japanese GDP would have gone up much faster than the chart that you saw earlier. But the fact that Chinese are already aware that there is this disease called balance sheet recession means they can do all of that once the leaders get the right advice. However, there are a few other things that we have to watch out, and that is that the construction sector in China is 26% of its GDP compared to 12% or 8% in the United States. So if construction sector shrinks by even 10%, Chinese GDP will be down 2.6%. And that's a big number. And so I would argue that if they're going to use fiscal stimulus, I wish that they will use the fiscal stimulus to help the construction sector, not necessarily the companies, but to make sure that all the building projects that they started are actually completed. I think that's the most efficient way to spend money in China today, to complete all the projects that were started, because that way you don't end up with huge non-performing loan problems for the banks and people who put the money to buy those houses who actually get those houses at the end of the day. So saving the construction sector, I think, should be the first priority of the government. And I see that the Chinese government's already doing something to that effect. But without a big fiscal stimulus to keep the GDP from falling, it may be difficult to keep helping the construction sector. You have to have both the macro background and the micro targeted help to the construction sector to make sure that economy doesn't collapse totally. Now, one other thing that I'm very concerned about China is this development here. So this is the Chinese version of the chart that you saw earlier. You notice that actually Chinese companies stopped borrowing money starting around 2015 to 2016. This is long before the bubble burst. And China, at this current state of economic development, China is probably where Japan was in late 70s or early 80s. They should be borrowing money and expanding their businesses. I mean, they have so many competitive products, huge current account surplus, huge trade surplus, indicating that Chinese companies are very, very competitive globally. And if you're in that situation, you should be borrowing more, investing more to expand your business. But instead, starting from around 2016, they have been reducing their borrowings. But the household sector kept on saving money, as you can see here. So if the company stopped borrowing, the government had to borrow. So as you're aware, many regional governments had to do this borrowing to keep the Chinese economy going. And as a result, central government balance sheets are pretty clean. But the general government meaning if you add the central government and the regional governments together, they have been running something like 8-9% of GDP deficit to keep the economy going before the bubble burst. So once the bubble burst and then you fall into balance sheet recession, they have to go from here down all the way like this. And that could be quite a challenge for the Chinese financial market, because now they have to then finance the government deficit, the huge amount of government deficit that will be coming, so the government can offset the deleveraging that will be happening as a result of balance sheet recession. Fundamentally, let me skip this. Fundamentally, I'm not worried about financing of the budget deficit in China. I mean, a lot of people, I understand, are talking about huge debt burden in China. But if the debt is such a big problem, as some people are making it to be, government bond yield cannot be coming down like this, right? Government bond yield should be going up like that. The fact that the government bond yield is coming down right now at 2.6% for 10-year government bonds suggests to me that even though debt is very large, savings is even larger. But no one talks about savings. Everyone talks about debt. And I think that's a huge mistake. We should look at both savings and debt to see whether the debt is too large or too small. And we cannot tell that directly, but we can tell that indirectly through the bond yields. If the bond yields are coming down, that means debt is not a big issue. If the debt, bond yield is going up, then it's a big problem, and the government should cut the deficit. The fact that the bond yield is coming down in China suggests to me that financing of the debt is not a problem. How you finance the debt between the regional governments and the central government, that is the issue, as I indicated to you earlier, because regional governments are probably close to bankrupt, so the central government has to do the job. So there will be some of these shuffling of responsibility and things like that. But at the most fundamental level, the fact that government bond yield in China is down to 2.6% suggests to me that there is no debt problem. The problem is excess savings in the private sector, as you saw earlier. Let me skip that because I'm running out of time. The other reason why Chinese companies may not be borrowing money may be because of these geopolitical issues. As you know, the West, so-called West, and that includes Japan and South Korea, accounts for 56% of global GDP, per capita GDP of 60,000. And the non-West, so that's Russia and those countries, 25% of global GDP, per capita GDP of 13,000, which is not much different from the China's own per capita GDP. So if this deglobalization and decoupling, some Chinese companies felt that they might be losing this market and that have to rely on this market, then maybe they won't be investing as much as they used to. And that may be one of the reasons why Chinese companies reduce their borrowings. And finally, China is facing so-called middle income trap. Middle income trap means if you have the lowest cost producers, all the factories from around the world will come to you to set up factories. But once someone else becomes the lowest cost producer and your costs have gone higher, then all these factories will then start moving to the other places like Vietnam, Indonesia, maybe even India, Bangladesh. And China, I'm afraid, is exactly in the middle of the middle income trap. And so if you're in the middle income trap, the government will have to do all sorts of, government will have to take all sorts of measures, deregulation, tax cuts, to make sure that the companies stay in China and not leave China. And I hope those measures will be put in place, because otherwise you could get stuck in this middle income trap. And I'm afraid not many countries have managed to come out of middle income trap. Japan, Taiwan, South Korea, Singapore, those countries managed to come out of middle income trap, but so many other countries got stuck in it. And so I hope the Chinese government takes appropriate action to make sure that you don't get stuck here. And finally, of course, the population. And a lot of people associate Japan's problem with population, but Japan's population did not peak until 2009, which means the Japanese economic slowdown from 1990, the bursting of the bubble, to 2009 cannot be explained with population decline, because population was actually increasing during that period. And most of the worst deflation in Japan was before 2009, first 10, 15 years, as you saw earlier. In the Chinese case, the population decline and the bursting of the bubble are happening on the same year. And so that's going to be a huge challenge for policymakers, especially because if population is declining, many Chinese people may start thinking that house prices will not go up any higher from where we are now. And if they believe that house prices will not go much higher because population is declining, then they might not want to borrow as much to invest in these real estate. But if they don't borrow, someone else has to borrow to keep the economy going because household sector is still saving money. So putting this all together, I'm afraid China's challenges in 2023 is actually bigger than the Japan's challenge 1990. Japan had this bursting of the asset price bubble and a balance sheet recession. That was pretty serious. And Japan's balance sheet recession probably was far bigger than the Chinese balance sheet recession. And they did not know which disease they are faced with. So if you go to a hospital but the doctor doesn't know what disease you have, the situation is pretty bleak. In a Chinese case, balance sheet recession is likely to be much smaller, and the doctors already know the disease. So if they put the correct treatment, it will not. People may not even notice that there's a recession because GDP is maintained. They actually grow if government action is large enough. So that part is the Chinese situation is better than in Japan. But then there's a construction recession, which Japan didn't really have to deal with. And then the businesses reducing borrowing before the bursting of the bubble since 2016. And there's a number of reasons, geographical confrontation with the West, middle income trap, regulatory tightening, regulatory uncertainty, population decline. And one other part that I worry a little bit, especially for China, is that during the pandemic in Japan and in the West, government gave lots of money to households and the companies. So they were able to manage the period. But I understand that Chinese government did not give so much money to companies or households during the pandemic. What that means is that many households, many companies had to deplete their savings during the pandemic. So once the economy returns to normal, they want to rebuild their savings to what they think is more comfortable level. But if all of these companies and households try to rebuild their savings, that's another balance sheet recession from the asset side, not from the liability side. And this is something that Japanese never have to worry about. But this may be one of the reasons why people are not borrowing so much in China, people are saving so much in China, because they want to rebuild their savings that was depleted during the 3 years of COVID-19. So putting this all together, I'm afraid China's challenge to 2023 is a little more serious than the Japan's challenge 1990. But of course, Chinese people are still willing to work hard, willing to study hard. So there are a lot of good things that are still going for China. But this is a very delicate situation with, for example, population decline happening on the same year as the bubble burst, which may reduce people's expectation that house prices will continue to go up, and that may reduce their borrowings, which then add to the balance sheet problems and so forth. So I hope government gets the right advice and do appropriate fiscal stimulus, as well as some measures to make China a more attractive place to invest for both domestic and foreign companies so that it can get over the so-called middle income trap. If those policies are put in place, with Chinese people still willing to study hard, willing to work hard, I'm sure China will do much better. But if some of these policies were not put in place, then this current slowdown could continue much longer than, in my view, necessary. Thank you very much.
Okay, thank you, Richard. Thanks for joining us in PFF 2023. Looking forward to see you next time. Thank you.
Thank you.
好的，谢谢顾先生。那随着顾